in this video, I'm going to share with you risk versus return. This is going to be a very interesting, particularly if you are planning to invest into commercial property. Understanding risk versus return is a key formula. If you want to know, then stick around. Now, when you invest into commercial property, one of the things that people always see about and talking about is the vacancy rate. There will be a long vacancy, because if there is no vacancy risk, there is literally no risk in commercial property. As long as your property is tenanted, you are always going to make money. So what you need to do is that minimize the vacancy risk. Let us understand about your property, where you are buying. First of all, where you are buying and why you are buying and what are you buying is a key consideration about commercial property. Let's talk about where you are buying. You can buy it's in metro, which is like a core CBD area, Sydney, Brisbane, Melbourne, and the top part. And if you buy those assets, of course, this asset value would be high, right? The net return would be little bit lower than that other area, which is little bit further from the CBD. So which is why when you're talking about where you want to buy, the further you go from the CBD, the better return that you can get. So in other words, like let's say if you want to buy a property in Brisbane versus if you want to buy a property in Sunshine Coast or in Gold Coast or sometimes even let's say Rockhampton, Townsville, there would be a difference of net yield. Brisbane is just, let's say if you can get 6%, in Rockhampton or in Townsville, those you can get even 8%. The key question that you will be asking is that if you buy all your commercial property in Brisbane only, then your net return would be significantly low. On the other side, if you buy everything is in the Rockhampton and Townsville area, then your net return will be high. But the risk remains that if the property comes to vacant of all these areas, how quickly you can tenant it, how quickly you can make it tenanted. And if you do this analysis, you will see that all you need is one tenant. In your property you need one tenant if something happens, if the current tenant moves out, and one business literally you need. So you need to look into, in terms of the risk, how much risk you are really taking. If you buy a property which is like a completely regional, there's only 1,000 2,000 populations there and the number of business is handful, and if the current business, if they just move out, and it will be very difficult, perhaps you are taking a huge risk. On the other side, if you are buying into Sydney or in Brisbane CBD, where there are millions of people living, so there are multiple businesses that is going on, and if one tenant moves out, the other tenant is easy to find out, perhaps you are really taking no risk, almost zero risk. So the question that you will be asking is that, is it worth going for a little bit less rental return and then buy in the CBD area than going to completely regional and buying this with a high return, but then there is a risk of vacancy, of no longer vacancy? And the answer will be, it depends like what you really want to achieve. Sometimes if you have like few assets already in the Sydney or Brisbane on these core CBD areas, perhaps you can think of, okay, I would now be able to hedge or minimize that. I can take a little bit of risk and go for a return. Ultimately, if you have a 3 commercial property strategy, you should be buying 3 commercial properties, one in core CBD or Sydney, one asset class, another one is somewhere in between, like let's say in Brisbane term, let's say in Rockhampton or Mackay or Gympie or Ipswich or Toowoomba, this kind of areas. And then one property you might think of extreme in a different state altogether, because that's how you are minimize the risk. That's how you are minimize the risk and also averaging your return, because you need one return for let's say 6%, another one is the 8%, another one is 7%, and that's how it becomes 7% return. To understand the risk versus return is how much risk you are actually taking versus how much return that you are getting. If you are taking a little bit of risk, you need to make sure that you are getting return appropriately. And if you're taking way too much risk, then you need that asymmetric return, which means like, yes, I can buy something which is right now giving me 10% return, but because it's a huge risky item, there is a chance that I can even get 50% return by doing this and this. And this kind of things you can play but you need to make sure that if you lose that rent completely for 6 months or 1 year, you would be able to sustain through other portfolio. Which is why if you are buying your first commercial property, you need to be a medium risk and a medium return kind of things, which is like you're not taking a lot of risk. In fact, the risky level would be really low, and the return would be again kind of a medium as well. It can't be too much. So I always say that one step approach, which means the risk would be low, return would be medium, rather than risk is medium, return is high, or risk is high and return is very high. So you can go in this approach of risk high and return very high, but then because of the risk, I would rather be on the risk low and the return medium zone as my first investment property. So the more and more, which is why good quality asset in a good suburb or in a good metropolitan area, it depends on what assets you will be buying. Again, it could be a retail, it could be an industrial, it could be even office as well, but you need to see that what kind of return that you are getting as opposed to what kind of risk that you are taking. First investment property, again, it's person to person. You understand that the more risk that you will be taking, you need to see that the more return you are getting. And as long as you can hedge, you can say that, okay, I am 40 years old and I have a good stable job. So even though I'm not getting the return for next 6 months, like when the tenant is going to move out, let's say if it happens, I am willing to take that bet because I have that backing of this job, because I'm only 40 years old. Next 10-15 years I'm going to continuously working on that. Perhaps your strategy will be something that hey, I want to take this risk, and as a result I want a better return, because if the risk works and if the return gets, then it will actually help me to fast track my financial journey, and it will actually help me to become financially independent quicker. On the other side, if you are in your late 50s and you are already starting from a base, you perhaps should be thinking that no, I would not buy a property which is like a 8% 9% return in a high risk area. Perhaps I would think about buying something which is very close to the core CBD area and the return is only 6% or even 5%, but the lease is long term and it is quite safe and secured. Even though the tenant's business moves out, another business will come in easily because of the location and the proximity. So you see that as your, just with these two examples, as your age becomes more and more, you need less risky person, versus if you are younger, somebody who is even 20s, they are starting their commercial property journey, they can take huge risk because that's how they are their early 20s, so they would be able to take that risk, which is why they should be buying a completely sometimes even regional areas where the return is high and they need less deposit. There are some different way they can create the deal, so even though they do not have any deposit from their own pocket, they can still buy the deal and manufacture and create something from that deal. So this is how you should be looking at the risk versus return. Remember, it's the always one step ahead of the return from the risk is something that you need to look into.